Good evening, ladies and gentlemen. If you could find your seats, we'd like to begin the presentation shortly. Thank you. So good evening, ladies and gentlemen, and welcome to our presentation entitled Potential Tax Implications to Owning U.S. Real Estate. My name is Corey Johnson. I'm the Director of Wealth Management of ScotiaMcLeod here in Winnipeg. And ScotiaMcLeod is partnered this evening with Myers Norris Penny and Thompson, Dorfman, Sweatman to bring you tonight's presentation. The theme of tonight's presentation is of particular importance to Canadians for many reasons, but a few of which come to mind. I guess first of all, demographics. There's a group of Canadians, which some of you may have heard of, known as the baby boomers. Now, as baby boomers, that group is quickly, approaching retirement. And especially when they live in the western part of the country, the idea of owning a piece of U.S. real estate in the sunny parts of the world where they've never heard of temperatures of minus 30 is somewhat attractive. Secondly, the Canadian dollar. It wasn't all that long ago that if you wanted to purchase one US dollar with Canadian dollars, it would have cost you about $1.50 Canadian. Well, as of today, it costs you all of about $1.08. So quite a significant difference. I guess thirdly, we as Winnipeggers and Manitobans love a great bargain. And rumor has it, depending on the geography or the type of place you're thinking of purchasing, U.S. real estate is anywhere between 20 to 50% off of its high prices. So for these reasons and more, many Canadians, specifically Manitobans, are considering or already have purchased a piece of property down in the U.S. So we, three organizations, recognizing that this is a very topical thing, we decided that a lot of people didn't realize that there are potential tax implications to owning U.S. property, even though you are a Canadian. It's one thing to pay tax to your own sovereign government, nothing that people are overly happy about. However, it's another thing to have to pay tax to a foreign government, simply because you own a piece of property there. So we felt that it was prudent to host this seminar, I guess this is the second one we've put on, to help educate all of our clients on just the potential tax implications of owning property down in the U.S. So in the interest of time, because as I had mentioned, this is the second presentation we've put on this topic, and we recognized after the first one that there were a number of questions and there was a lot of interest, I'd like to jump right in. Our first speaker is from Thompson, Dorfman, Sweatman LLP. TDS, as they're also known, was formed about 120 years ago. They currently employ some 70 lawyers and support staff of about 100. TDS has worldwide connections and is one of the founding members of Lex Monday, the world's leading association of independent law firms. Lexpert has recently recognized TDS as the leading corporate law firm in Manitoba for the third year running. At this time, I'd like to introduce Peter Glowacki. Peter practices law primarily in the areas of wills, trusts, and estate law, including all aspects of estate planning, administration, and litigation. In addition, he is actively involved in charity and not-for-profit law, and also corporate and commercial matters, including business acquisitions and financing and commercial real estate transactions. Welcome, Peter.
Hopefully everybody can hear me. I'm going to stand. We, I think as a group, have decided not to walk around the room because for sure one of us, and likely me, would fall down while trying to talk and read and etc. So I am going to speak first, then Christa, and then Blair. I will be dealing primarily with the issue of Canadian tax issues in owning U.S. Real estate. Partly because of my own background, though, being in heavily into wills in the States, I also touch upon some of the estate-related issues that all tie in. And I did want to emphasize that right now, that looking at and acquiring a piece of property in the U.S., you should definitely be looking at, I guess, at the big picture. It's not just, what are the U.S. tax implications? What are the Canadian tax implications? It's a purchase in a jurisdiction in which many of you will not have had a lot of experience, and there's a whole set of different criteria, a different regime that comes into play, and so you definitely want to be getting, I'll call it a team approach in terms of your advice. Again, I practice primarily in Canadian tax and estate planning and the like, and trying to help Canadians with that type of those types of issues, but there's also the whole U.S. tax side of the equation, and it all meshes together. It's all quite complicated, which isn't to discourage you, but you just want to be looking at the big picture when you're going out and making the purchase, and not writing up the offer and having everything signed up and then calling one of us and saying, oh yeah, by the way, close on Friday, what do you need to tell me? So again, just keep all of that in mind, because I'm sure we've all had the experience of buy first, do the planning later, and unfortunately at that point it gets a heck of a lot more complicated. So with that prelude, I'll get into it. Hopefully I'm going in the right direction. I am, okay. So again, I'm dealing with Canadian tax and estate issues, and just in brief, the points that I'm going to try and cover off in a fairly brief period of time. Questions after all of us have spoken. What type of property do you have? And really with that, I'm looking at, is it a personal use property only, or is there going to be a rental component to it? There's differences and implications if you do want to be renting out your property. What happens on the disposition of the property? In other words, when you die, when you sell it, or what have you, and planning considerations. And in there, I've tied in a few of the estate planning specific type things, just as something to keep in mind in all of this. So, moving straight into the issues. The difference here: personal use property, or is it going to be a rental property? Personal use is probably the most straightforward, if I can put it that way, in terms of the least number of complications. That doesn't mean it's necessarily the best way for you to go, but in terms of reporting and record keeping and what have you, and the potential probably for reassessment, it's going to be one of the more straightforward ways of you using the property. You're buying it, you're using it for your own personal use, you're not renting the property out. No income to report, no expenses that you're going to be able to deduct against anything. I mean, your expenses for operation, there's no income to write them off against. You're not going to be able to write off any expenses relative to your property. You will have, when you dispose of the property, the potential for a gain, a capital gain, realistically, on the increase in the value of the property, which could include U.S. reporting requirements. Again, Christa is going to get into the U.S. reporting side of the equation, and I'm trying not to step on her toes in terms of the different issues here. But the importance on the gain on the disposition of the property is you need to keep good records relative to your original purchase of the property, and also any capital improvements that you make to the property. You're going to have the documents to support them. To the extent that you're able to increase the amounts that you put into the property, that's going to lessen the amount of your capital gain that's ultimately going to need to be reported. If you have a property and you have a loss, so it's gone down in value, which if you bought 5 years ago down in the U.S. and you're now trying to dispose of the property, there's a pretty good chance that you're in a loss situation. For Canadian tax purposes, you're deemed to have no loss. In other words, you're not going to be able to write that off against your income taxes in Canada. Now, on the other hand, if you have a rental property, and this could include that you're using it personally and renting it out when you're not there, you're only going down to the property for 2 or 3 weeks or a month or whatever out of the year, and the rest of the time that you're renting it out. You will have income to be reporting. I mean, it's income for tax purposes. But there's also the ability for expenses relative to that property to be written off against the income. And so you're going to be able to be deducting those expenses, but you need to be keeping, again, accurate records and good receipts and what have you as to the expenses that you're actually incurring on the property. there is you can't create a loss through the depreciation of the property. So just like in Canada, when you have a rental property, you can slowly depreciate the value every single year. You can't depreciate it such that you create a loss, though, for income tax purposes. And again, on a disposition of the property, you can have a gain, but you can also have a loss. And that's one of the bigger differences, again, between a personal use property and a rental property. It is possible for you to have a loss. If you sell it for less than the property is actually worth, or originally acquired for, you will have a loss that you can use for income tax purposes and offset it against income. The one thing to keep in mind, which is one of these things that sort of comes back to haunt people down the road, depreciation. You're slowly depreciating the value of that property over time against your income. But when you go to sell that property in the future, if it's gone up in value, not only are you going to have potential for capital gains tax, the difference between what you originally bought it for and what the new fair market value is, or what you sell it for, but also to the extent that you've slowly depreciated that property down, you're going to have what we call recapture for income tax purposes. And basically, all that money you're able to save in income taxes over the years and write off against your income is all going to get added back into your income in the year that you sell the property. So just something to keep in mind. I mean, if you get an opportunity to sell the property and it makes sense, great. Just keep in mind there's a lot of different tax implications that are going to come into play. Okay. In terms of other rental issues to keep in mind, there has to be a business purpose in order to be able to deduct the expenses. The REOP is reasonable expectation of profit. From Revenue Canada's point of view, you have to have an expectation of actually having a profit from the ownership and the rental of the property. You can't just be owning this thing, using it most of the time and trying to write off a pile of expenses. If you don't have an objective, reasonable expectation of profit, there is the possibility that Revenue Canada is going to disallow your expenses, or at least, basically disallow your expenses if they don't believe you've got a reasonable expectation of profit. So you've got to, theoretically, at least annually look at the property and make sure that you think you've got a reasonable expectation of a profit on that property, or you risk having your expenses that you've claimed disallowed, and then you're looking at interest and penalties and on a reassessment. So again, just keep that in mind. There is potential issues as well with a mix between personal use of a rental property and also renting it out. You're going to have to allocate your expenses against your own personal use of the property versus when the property is being rented out. Again, keep good track of all of your records for tax purposes. The time that you're using the property versus the time that the property is being rented out. Again, we're dealing with sort of Canadian tax-related issues. Many of you will be familiar with the general notion, but you've got to keep in mind that these are also going to be applicable to a property that you're acquiring in the U.S., and you've got to be able to keep track of all of this. There's also the potential for the impact on that whole reasonable expectation of property notion. If you're using it personally as well, it's not a pure commercial investment from Revenue Canada's point of view, and so that may impact on the reasonable expectation of property and the test that they're going to apply against you. The other thing is that if you're hoping to write off your travel down to the rental property, you can probably forget it. Revenue Canada is generally not allowing those travel expenditures as an expense that you're going to be able to write off. So that's a quick review on the rental issues that might arise. Dispositions of the property, and there's a few different ways that you can have a disposition of your property. Obviously, the number one is sale of the property. If you sell the property or you've received funds for it, and you're going to have to look at your potential for a gain or a loss, then again, depending on whether it's a personal use or a rental property, on whether you have the potential for the use of a loss for tax purposes. If you have a sale of the property to somebody who's not at arm's length from you, for example, a child, you are likely going to be deemed to receive fair market value for that property, even though you didn't get that from the non-arm's length person, again, like a child. So if you receive nothing, or if you receive some lesser amount than what the actual fair market value is, Revenue Canada may deem you to receive fair market value for it. You might have a big tax bill and not the cash from your child or, again, non-arm's length individual to pay that tax bill. So keep that in mind. Again, analogous to the, well, it really is the same as a piece of property up in Canada. On death, you have a deemed sale or disposition of your property at fair market value on your death. And so you basically need to keep that in mind. You again have a potential for a large tax bill to be payable by your estate, depending on how you own the property at that point in time. And again, that can be, in some circumstances, a pretty big tax bill that has to be footed and may result in the need to sell the property in order to be able to pay that tax bill. You could also have a disposition, and again, this is one of the deemed ones, triggered on the change of use. So if you were using it personally and you want to change it to a rental property or vice versa, from a tax point of view, you've got a deemed change of use, a deemed disposition of that property, and you may have a tax consequence. Again, if the property's gone up in value, you may have a gain that's triggered at that point in time, and there may be taxes that result from that. And the other thing to keep in mind is that there's the potential for double taxation. You're looking at both, you're dealing with Canadian tax regime because you are a resident of Canada, but you also have to worry about the US tax implications that Christa's going to be getting into. And there's the potential, because you're dealing with two different systems, and they are most definitely not the same in the way their income taxes and estate taxes work. There's the potential that you may have some potential credits that you can't offset properly, and so you have to examine those types of issues. The other thing is that U.S. estate tax is generally not an income tax. It's a tax on the value of your assets, and this is a concept that we're not really familiar with in Canada because we don't have estate tax as such in Canada and haven't since the mid-1970s, as I recall. So again, just another consideration to keep in mind. In terms of planning, there may be the ability to elect to defer the gain on that change of use. In other words, that disposition that I talked about, you may be able to defer that. You may be able to use your principal residence deduction or exemption with respect to the property in the U.S. Just warn you that before you run off and use that exemption when you go and sell your property that's gone up in value in the U.S., if you have other property in Canada, you want to make sure you're examining all of those properties and all the potential gains, because generally speaking, you have one principal residence exemption available or deduction available for any given period of time. So if you have two different properties or three properties, you're only getting one deduction for a given length of ownership. So you want to make sure you choose the right one and not the first one that necessarily comes up for you. You may want to have the ability for your executor to opt out or elect out a spousal rollover. If somebody, first person dies, normally you have an automatic rollover for tax purposes. In other words, tax-free to a spouse. That may not make sense from a tax point of view. You want to at least give the ability of your executor to opt out of that. That way they can get the appropriate tax advice on both the Canadian and US side of the equation and potentially not have that automatic rollover. And you also want to consider joint tenancy versus tenancy in common. Joint tenancy, automatic right of survivorship to the surviving person. Tenants in common, you own a distinct undivided interest in the property. You know, two people have 1/2 interest each. It does form part of your estate. It is going to be, you know, probably you're going to need probate. You're going to have probate fees payable. But again, in the big picture, that may make more sense than a joint tenancy, depending on the all the different tax considerations. I'm just going to very quickly touch on a couple of other issues to keep in mind. Will issues, make sure that if you do buy a piece of property in the U.S. and it's in your name, if you have gifting provisions in your will, you want to make sure that you're clearly describing the property in terms of the gift. Check with a U.S. attorney to make sure that your will is going to be valid, that you've done a proper gift. The last thing you need is to have U.S. estate problems because you haven't got a properly drafted will. As bad as you may think lawyer fees are up in Canada, they're way worse in the U.S. And it probably is a fairly simple process to double check your will down there, but you want to make sure that that's looked after. You want to consider who your executor is. If you've got a U.S. piece of property and you're naming an executor who, for whatever reason, has some issues with the ability to go across the border, and that's becoming more and more an issue with all the U.S. border security issues, just something to think about. Have, as the person that you've named, got that ability to deal with it and deal with the U.S. property. I've dealt with a couple of tax-related issues. Sorry, I think did I just flip something? Yes. You may consider 2 wills, although generally speaking, I don't recommend it. Again, the executor-related issue. If an individual becomes a non-resident taxpayer of Canada and they receive something out of a Canadian estate, you have to get a clearance certificate. So some people are thinking about buying a property potentially for a short-term arrangement as they are getting more into retirement years or what have you. They may become residents down in the U.S. That is going to have some implications in terms of estate planning that you've done up in Canada. I'm not going to get into all of the detail, but I've given a bit of a summary at least in terms of the notes and the types of issues that you have to be aware of. And not only is it this for the person that's buying the property, but also if you potentially have children who are moving into the U.S. and you've set up a will and it leaves them as a beneficiary, you've got to keep in mind there may be some negative tax consequences to them. So again, I've tried to summarize it just because of time constraints. I'm not going to get into that issue very much. If you have questions afterwards, feel free. Powers of attorney, again, a lot of people will have a power of attorney, or hopefully you do. But again, if you're going to be spending any amount of time down in the U.S., you want to make sure that that power of attorney document is valid in the U.S. because they may need to deal with your property down in the U.S. Again, you're buying a piece of property potentially. You want to make sure that your attorney is going to be in a position legally to deal with that. Every state has different requirements as to what they require for a valid power of attorney. Make sure it's looked at and you have a valid one. And also, sorry, just living wills, healthcare directive living wills. Again, people are potentially getting more elderly as they're looking at these properties. You're spending periods of time down there. If you have specific wishes on healthcare, make sure that you've got a document that is going to be valid in the U.S. And I think that probably, again, it's a very summary basis. There is some notes here, and I'm available for questions afterwards. Okay, thank you.
Thank you for those insightful words, Peter. Our next speaker is from Myers Norris Penny LLP. MNP is they're also known. It is the seventh largest chartered accountancy firm and business advisory firm in Canada. With more than 2,200 team members, their professionals provide world-class expertise, in-depth knowledge, and personalized service to find the right solutions for you and your business. I'd now like to introduce Christa Walkden from Myers Norris Penny. Christa is a senior manager of Myers Norris Penny's taxation services practice. Based in Winnipeg, Christa specializes in resolving complex U.S. tax matters from a Canadian perspective. Throughout her career, Christa has served a diverse range of clients. She delivers a wide range of services, including U.S. personal tax compliance and U.S. estate planning. Welcome, Christa.
Thanks, Corey. Hopefully everyone can hear me. I think that should be good. All right, so we have a lot of information to cover in a very short period of time, so I apologize if it's a bit overwhelming. For purposes of the information that we're going to be going over today, we're going to be focusing primarily on non-residents, non-citizens of the U.S. Very different rules apply if you're a citizen or a resident of the U.S., and that's a whole other discussion. So just be cognizant of that if you fall into that category. So the first thing we're going to talk about is when do you have to file a U.S. tax return? Well, if you own the property just for your own personal use, generally there's no filing requirement until you actually sell the property. You're not earning any income from the property, you're just enjoying it for your own personal use. I would say as long as you manage the number of days you spend in the U.S. And we'll get to that in a second. If you intend to rent out the property, again, you don't technically have to file a tax return in the U.S., but it may be in your best interest to do so. And the reason being, if you do not file a tax return and make an election for your property to be taxed on a net basis, whoever rents from you technically has to withhold 30% from the amount of rent that you collect from them. That's a lot of money. And if you're paying for property taxes, and if you've leveraged your property and are paying interest expense, and you have ongoing maybe condo fees or association fees, that's money going out the window that you can't offset against that 30% tax. Furthermore, that 30% tax is not eligible as a credit against your Canadian income taxes. So you're picking up the rental income on your Canadian return, and that 30% is going out the window as extra tax. I would say that if you're renting to just Joe, any regular individual, they're probably not sophisticated enough to know that technically they're required to withhold 30% from you. However, if you're in any kind of a complex, that they may have requirements where they're going to manage that for you. So instead, you can make an election to file a U.S. tax return and report your property on a net basis. And what that means is you can claim depreciation and other expenses to grind down that value, the net income that you're subject to tax for U.S. purposes. And then that 30% withholding goes away, and now you're just filing U.S. returns. And if your property is earning income each year, you may have to file remit installments or estimated tax payments to the federal government. Another benefit to filing a U.S. tax return is if your property is purely a rental property and it's running at a loss, the loss provides no current benefit to you in the U.S., assuming you have no other U.S. source income or activity. However, if upon sale, if you sell the property at a gain, all those losses that essentially you gathered year after year after year accumulated, when you eventually sell the property, those losses get released and can be offset against the gain on the sale of your property. So, you know, the one sort of disadvantage to filing a tax return might be the cost. You have to get a taxpayer ID number from the IRS, and that can be a bit of an onerous process. For the most part, either you'll need help filing your tax return, or you may choose to do it yourself. One thing to note is we see a lot of what I would call mixed use property, where folks are going down and they're perhaps spending personal days in their property and then renting out for the balance that they're not staying in the property. And the U.S. has a rule that if you use your property for more than 14 days, then you will not be able to create a loss on your property. Okay, so you're going to be limited to a break-even standpoint, so that accumulation of losses will not be available, excuse me. Personal days, you have to be, if you're letting family members stay in your property for less than the fair market value of the rent, that will count towards your personal days. So you do want to be aware of that. Now, in terms of how long you spend in the U.S., impacts whether or not you may have to file a tax return, regardless of whether you rent your property or use it personally. The U.S., while they tax on citizenship, they also tax on residency. And they have a very specific test, and that's called the substantial presence test. If you're over that test, then technically you could be deemed a resident for U.S. tax purposes and need to file a return. Thankfully, if you're over that test, there's a form you can file by June 15th of every year that says, well, hold on, I have a closer connection to Canada, you can't make me file a return. The key is to timely file that form. If you miss the deadline, then you will now have to file a tax return, get your taxpayer identification number, and again, you can take a position under the Canada-US treaty to say, I'm still not a resident of the US. Now the treaty protects me, but now you actually have to file a return and you have to get that taxpayer identification number. That special form that you can file, the closer connection form by June 15th, the beauty with that form is you don't need a taxpayer ID number. So it's a lot simpler process. So you want to manage that. Now, what is the test? The key is on any given year, the test is 183 days. But it's not 183 days for the current year. It's a look-back period. So they take 100% of the days in the current year, 1/3 of the days in the prior year, and 1/6 of the days from 2 years prior. And if the sum of those, if some of that calculation is 183 days or more, then technically you're deemed a resident. So what a lot of people get caught up on is they think, okay, 183 days, roughly 6 months. You know, there's health care issues with being in the U.S. and immigration issues longer than 6 months. So everyone has the 6-month rule in their head. But actually, if you were to run through this formula and you were wintering in the U.S. on an ongoing basis, you really cannot stay down there, for more than 122 days a year. Because if we throw 122 days into that formula, that's going to get us to 183 days. So that's a significant difference in the number of days that you can spend. Now, it doesn't mean you can't spend that time. It just means file your forms. File that form by June 15th, and you're just declaring to the U.S. government, I was down there. Don't tax me, though. I have a closer connection to Canada. States also assess income tax. So what we've been talking about is the federal government. Most of the southern destination states, if you're renting out your property, impose a state income tax. Nevada, Florida, and Texas thankfully do not. So those are favorable destinations. But California, Arizona, North Carolina, South Carolina, New Mexico, and Hawaii all do. And the tax rates range anywhere from 4.5% to 11%. Okay? The top U.S. federal rate for 2010 is 35%. It is a graduated table, so you're getting up there once your income is at a certain level. In terms of filing U.S. returns, if you own your property in a partnership, a corporation, or a trust, and you're earning income in those from the property, then those entities will need to file U.S. tax returns. And in the case of a partnership, as partners in the partnership, you will also have to file personal tax returns in the U.S. So, key things to remember is consider making the net election if you're renting your property so that you're not subject to the 30% withholding tax, if it makes sense. Establish your tax losses if you're in a pure rental situation or the personal days are under 14 days. And just be cognizant of the number of days that you spend in the U.S. and make sure you're filing the proper forms. I switched up the order of the slides on you a little bit. To make sure that we're all still fresh, given this sometimes dry topic. So we're going to talk about sale before we talk about death. We thought that was more appropriate. So, so if you sell the property, you will be taxed on the net gain in the U.S., regardless of whether you own it personally or for rent. So this is where, if you've just had it for personal use, when you sell it, you will need to file a U.S. tax return. And the key is that the gain that you may have in your head from either Canadian tax, or no, I guess U.S. tax purposes, if you've bought it in U.S. dollars and then you're selling it in U.S. dollars, we're dealing with one currency, so we should be good. But one thing to remember is because you are a foreign seller, that the purchaser of the property, whether they're foreign or U.S., will have to withhold 10% of the sale price from you at close. This can be onerous if, for example, you sell your property in January or February of, say, 2010, and you actually, 10% of the gross proceeds is not it's not your gain. It's not equivalent to the tax that you would otherwise owe on the gain on your property. So the government is essentially holding on to your money until such time as you can file a tax return and get some of that money back. You will owe tax, U.S. tax, if there is a gain on the property, but likely not that much. There is, however, a certificate, a withholding certificate that you can file, and as long as you submit it prior to close or within 20 days of the close, you can elect for the purchaser to withhold on a net basis. So instead of 10% of the gross amount, they will withhold based on basically withhold the tax that you would otherwise pay when you actually file your tax return. Some people find that withholding certificate onerous. Personally, I think it's worth it if the timing makes sense. Obviously, if you're selling your property in December, you can file your tax return in January or February, so the IRS is really not holding on to your money for that long. But in other cases, you need to be cognizant of that. Similar to in Canada, assuming no depreciation has been claimed on the property, the capital gains rate in the U.S. is currently 15%. It is scheduled to go up to 20% in 2011. And some states will apply, most states would apply state income tax on top of the federal tax. The key thing to remember, though, is that special capital gains tax rates don't apply to corporations. So there's a whole host of other reasons why you don't want to own your property within a corporation, but one of them being is that you'll be taxed at a rate of, your gain will be taxed at a rate of at least federally 35% versus either 15 or 20% personally. And then you've got to get your money out of the company too, so there's tax at that layer. So my advice would be, if when it comes time to sell your property, I would consider looking into withholding tax certificate. I believe the realtors in the U.S. are can help you with that, or other people can help you with that to make sure you're making the right exemptions on the form. But you don't actually have to have the certificate back in hand from the IRS in order to get the reduced withholdings. So the big question is estate tax, and that's often the biggest challenge when we're dealing with owning property in the U.S. So it's important to note that in the U.S. that they tax on a gross value perspective, not on a gain. So if your property's worth $500,000 when you die, that the estate tax will be imposed on $500,000. They don't look at how much money you put into the property when you first bought it. Okay. Now, if your share of the property is under $60,000 US when you die, you don't have to file a tax return and an estate tax return, and you won't have to owe tax. The treaty between Canada and the US allows allows Canadians to avail themselves of the US exemption. Now, this is very tricky right now, because in 2009, any US person could essentially exempt $3.5 million of their estate from US estate tax purposes. And in the treaty, as Canadians, we get access to a portion of that $3.5 million. And what we have to do is we have to take the value of our US property over the value of our worldwide property and multiply it by that $3.5 million that So if your worldwide estate is under $3.5 million, you're likely not going to owe any US estate tax, but you still have to file a return. So that is important. The kicker here is the legislators in the US couldn't get around to fixing some legislation here. So back in 2001, when Bush implemented some significant income tax and estate tax changes, he had to put a sunset clause in. So what essentially, back in 2001, the exemption was only $1 million, and the highest rate for estate tax purposes was 55%. So now in 2009, or back in 2009, we were up to now $3.5 million of an exemption and a rate of 45%. But in 2010, he introduced no estate tax, and then that $1 million amount coming back in 2011. Now the legislators, Congress in the U.S. was supposed to get their act together and clean this up before the end of 2009, and they didn't. So technically, right now, there is no estate tax in the U.S. for 2010. What's likely going to happen, though, is they will get their act together sometime this spring, hopefully, introduce legislation, and most commentators, feel that it's probably going to be around that $3.5 million amount. But the challenge is that Congress is talking about implementing retroactive legislation, and then there's some folks that are saying, well, that's unconstitutional. So it's going to be quite interesting, and I really feel for those folks that have passed away since January 1, 2010, from an estate tax perspective, because as practitioners we're left in a bit of conundrum. So the key here is you really want to quantify your US estate tax exposure. And what I would suggest is, at this point, given where we're at with the legislation, is we want to look at like a $3.5 million exemption, but I think we also want to look at that $1 million exemption. If for whatever reason that does get reset back to the 2001 values, for sure no estate tax is not going to continue. So there is going to be estate tax. It's just, what is that magical exemption number going to be? And that has a major impact for us as Canadians. There is a provision if your asset is passing to your spouse, that essentially you can double up on that exemption, so that $3.5 million will go up to $7 million, if that's what we're talking about. If we're talking million, then it only goes up to $2 million, so it doesn't give us much wiggle room. It's important to note too that the definition of a spouse in the U.S. is much stricter than it is in Canada. So same-sex relationships, even though recognized in Canada, are not recognized in the U.S. And so passing property in that situation to your partner would not qualify for the extra bump, the extra double up on the exemption for U.S. purposes. You do get a credit on your Canadian return for any U.S. estate taxes paid, so you want to factor that into the analysis. So it is really important to assess it if you were to die today, or project it forward as property values are increasing, because as your worldwide estate and your personal property may, you may not be over $3.5 million today, but flash forward 5-10 years, you may get over that $3.5 million. So you want to plan for today as well as in the future, because it's a lot easier to manage the estate tax exposure if you get into something sooner than later when you have a problem. It's also important to note that the numerator in that formula, U.S. property, is also going to include any shares that you own in U.S. companies. So you own stock in Coca-Cola, that's going to count in your numerator, okay? And essentially you'd be subject to tax if your vacation property or rental property is going to boost you over that, say, $3.5 million mark, then we have to pull in now all your other U.S. situs assets. It does not include mutual funds. It does include U.S. stock that you own in RSPs. It doesn't include mutual funds that own U.S. stock that are in your RSPs, but it does include stock. So again, if you own shares of Coca-Cola in your RSP, technically the IRS is going to not recognize the nature of the RSP, and they are U.S. situs assets. As Peter mentioned, how you own the property depends on how you're going to be taxed for U.S. estate tax purposes. So joint tenants versus tenants in common. One thing to be very careful of is a lot of times folks will purchase a property, perhaps with their spouse, and so that the idea is, well, I'm splitting the value of my U.S. property 50-50 between myself and my spouse. If you cannot prove that you both equally contributed to the purchase of the property, whoever technically purchased the property and footed the money for the property is going to have the estate tax inclusion. So for example, say you have an income earning spouse and a non-income earning spouse. You set the property up as joint tenants. Technically, if the income earning spouse is the only one that has earned the money and put the money towards the purchase of the property, they will not have a 50-50 split. It will be 100% inclusion in their estate when they die. Okay, so that's very important. And the IRS, the onus is on you to prove that your spouse contributed to the property. We had a client in our Abbotsford office. They did a 3-year battle with the IRS to prove that the spouse did actually contribute to the property. With joint, the nice thing about joint tenants is that there's, as Peter mentioned, rights of survivorship. So you don't, upon death, that your share passes to the remaining surviving tenants, and your property does not have to go through probate. Tenants in common, however, again, as Peter mentioned, you each own your own divided interest, so you want to make sure that if you want to specifically bequeath your share of the property in the will, if you wanted to make sure it goes to your spouse or children, that property will pass through probate there, and that's where, as Peter mentioned, you want to make sure that your executor doesn't have any issues going across the border, as they're going to have to manage that probate process. If the property value is significant enough where it would warrant a valuation, tenants in common, because you only own your sort of undivided interest in the property, you can apply discounts to the value when it's included in your gross estate, but you need to have someone that's going to do a valuation on that. And again, it may not be worth it if the property value isn't significant enough. You also have to be careful, because with tenants in common, remember, each person owns their own share, and technically they can go give their share of the property away to somebody else or sell it, and that could get really dicey if you went in with your neighbor and they've decided to go off with decided to give the property to their kids, and now you own this property with their kids. Owning shares in a Canadian company is not subject to U.S. estate tax. And so a while back it was popular to own property within a Canadian corporation for that purpose, but the CRA now has sort of blown, and even the IRS has sort of blown the benefits of that away, and there's current income tax issues with that, so it's not a good structure, even though it does provide some protection from an estate tax purposes, estate tax purpose. Owning your property within a partnership. So this might be advisable if you're renting out your property and it's solely for rental purposes. Whether or not your partnership interest is subject to U.S. estate tax is open for argument, I guess. There's no clear answer. Some arguments would say that it is, and some arguments would say that it's not. There is sort of a back pocket election that you can do on death to help mitigate that exposure. So you definitely want to talk that through with an advisor. There's obviously trust ownership for vacation property. Again, it's very important that that's executed properly, and you really do need to talk to an advisor and look at it from both Canadian and U.S. tax purposes, because the trust agreement has to be structured very specifically, and you as purchaser are going to give up you're going to give up control of your property in favor of the beneficiaries of the trust. Some states do impose an inheritance tax on top of the federal estate tax. Most southern destination states actually don't. North Carolina is an exception, although in some cases you may still need to file a return. So for example, in Florida, there's no additional estate or inheritance tax, but you do have to still file a return. One way to help grind down the estate tax inclusion, if you're over the $3.5 million amount, is to try and get non-recourse debt against the property, so then you can reduce the value of what's included in your gross estate by the value of the debt. The only issue there is it is tough to get. You can only, for Canadians, it's tough to get. Most banks will only give you up to about 50% of the property value. And then you have to remember that as you're paying down the debt and your property value is going up, that value that the debt is giving you for estate tax purposes is going to go down. So there's also a lot of other nuances with regards to gifting. So just be very careful if you're, adding your kids on title all of a sudden or taking them off title. Each time you do that, that's a transaction, and it's going to have both Canadian and U.S. tax implications. So you just want to be very careful of that. Blair's going to walk through with you how you can use insurance to help mitigate your U.S. tax exposure. And so for U.S. estate tax purposes, it is important how you own the property. You want to quantify your exposure as your worldwide estate over, well, let's use $3.5 million now for argument's sake. And just be cognizant of that formula. So the big question is, okay, so how do I own my property then? Given all these rules and estate tax and personal preference, how do I own my property? And unfortunately, there is no right answer. We kind of put this table together to summarize some of the factors that you might want to consider and how each one of those properties or each one of the structures fares. You'll see, I think you'll be able to see that in no structure do we have green all the way across. So there's no one structure that's going to give you benefits in all the different factors. And so that's why you have to sit down, look at your personal situation, look at your personal preference, your risk tolerance, your ability or desire to have control over the property, etc. Structuring at the onset is preferable. It's a very difficult, if not, without triggering tax, to get, say, property into a trust, if that's what you do, if that's what you want, if you've already purchased it personally. So it's very important to talk to someone in advance. One thing that's very important to realize and appreciate is that if you're going down there and you're engaging a U.S. CPA in the southern destination state that you're going, they may not have appreciation for the fact that you've got specific rules in Canada that you have to abide by. And one of those is it's very popular in the U.S. to own property in a U.S. LLC, which is a limited liability company. Unfortunately, Canada doesn't appreciate the tax benefits that structure provides to Americans, and it can result in upwards of 70% overall effective tax rate. So just be very careful, because it's no fault of the U.S. advisors. They're just thinking from a purely U.S. perspective, and it works great in a purely U.S. perspective. They don't have an appreciation that you're Canadian, and it doesn't work well for you, and there's other structures that you can get in besides that. So in summary, it can be complicated, but at the end of the day, you're buying property, you want to enjoy it, you want to get down there. So I hope I hope this doesn't sort of scare you off the benefits of the other benefits of owning property. That's where U.S. tax and Canadian tax advisors can help you with the complications. Be informed. Be proactive, understand the rules, and as Peter said, you're better off to at least have a discussion with someone in advance of the sale, because it's a lot more difficult for us to help you out after you've already purchased it if you're not in the right structure given your circumstances. Don't rely on what your friend did. They may have different tolerances for some of those factors. They may have different personal tax situations, so be respectful of your own personal situation and make the decision that makes sense for you. And as I mentioned, be wary of U.S. advisors that will recommend LLCs, U.S. LLCs. Thank you.
Thank you very much for those wise words, Christa. Our next speaker is from ScotiaMcLeod. ScotiaMcLeod, as an organization, was formed as a partnership back in February of 1921. The foundation laid at that time was rooted in trust, financial expertise, and innovation, strengths that have prevailed ever since. In 1987, the Bank of Nova Scotia purchased McLeod Young Weir, as it was then known, having identified it as one of the most well-established and respected firms in Canada. ScotiaMcLeod is a leading financial services provider with over 800 wealth advisors in some 70 offices across the country. I'd now like to welcome Blair Smith to the mic. Blair joined ScotiaMcLeod back in 2008, and he has over 16 years experience in the financial services industry. He has a very extensive knowledge and expertise in both personal and corporate estate planning. He is very involved in the insurance industry, having recently chaired an advisory council insurance for professionals and leading Canadian life insurance companies. So please help me welcome Blair.
Well, hello everybody. Can everybody hear me okay? Everybody hear me at the back? Okay, bring the insurance guy at the end because everybody would leave if I was at the beginning. So we'll wrap this up very, very quickly. It's cold outside, and a lot of our clients of our firms are already down south, and hopefully they've got great advice from the likes of Christa and Peter, because as you can see, it's quite complicated, but that doesn't necessarily mean that a number of you or in the room may still be interested in buying property. So my message tonight is to talk to those individuals who have decided that after consulting with their professional advisory team, that this is a good decision for them as part of their net worth and their retirement plan. So the three key messages that I want to talk to tonight are: how do we deal with that U.S. estate tax issue that Christa was kind enough to share with us? Second, to kind of go through an example. We can talk about the tax, but Christa said, let's quantify it so we know what we're exposed to, and then let's plan around it like we have with regards to the structure, where we own it, and how we do our wills and powers of attorney with it. And third, there are some special considerations that, as we've just discussed, between U.S. and Canadian tax issues that we need to be aware of, and that includes insurance planning, and I'll talk to that in conclusion. So if we go to the next slide there, the need for funding, and again, this is Canadian residents owning U.S. property. The U.S. residency issue is not the discussion as we talked to earlier. We're going to focus on Canadian citizens with the U.S. property. We've talked about this unified tax credit, which we get a partial credit on the tax, U.S. estate tax issue. And the number that we really have to keep in mind is that $3.5 million number in net worth, global net worth. And we're going to walk through an example of what that could mean. Again, we don't know what's going to happen, and you could say that 2010 is a good year to die, but I don't think any one of us in the room would like to do that, especially if we have a place to go down when it's 30 below up here. So that tax issue is 45%, but we do get some credit back. We'll walk through an example. Property values today, again, another reason that Corey talked earlier, are at a bargain, and we would consider that now might be a good time to buy because of the dollar, because of the values. So when we're looking at U.S. estate tax issue, we could expect that if we live another 10, 20, 30 years, that tax could get higher as well. So we need to be thinking of that in our estate planning. So if we go to the next slide, I'm going to walk through an example. and this is just to demonstrate that there are individuals that are going to be over that $3.5 million, and this is not an uncommon thing for clients' situations. If we look at just an example of Canadian residents, it wasn't long ago that we never believed we would have $1 million home in Winnipeg, and we had a record year for sales of homes in Winnipeg going for more than $1 million. So Canadian residents over $1 million, RSP portfolio of $1 million. If you had shares in a Canadian controlled private corporation, so many business owners that we work with could have businesses worth $5 million in this example. And they may recognize already the benefits of having life insurance for some of their funding for Canadian tax or for some business needs. So they may have $1 million life insurance contract. They may have a U.S. stock portfolio, as Christa alluded to. U.S. stock is U.S. situs assets, so it would be included that U.S. tax calculation. And then if you had a property, now $1 million property, we might laugh at that now because we hear of all the good bargains, but again, thinking ahead and knowing clients that have bought some big properties down in the U.S. because they're at discounted values too, this is maybe not as unreasonable as it looks. Anyway, if you do the number crunching, and of course this would be Christa's job to help kind of work through that calculation, we'd have a U.S. tax liability in 2009 of about $490,000. So the number is real, and this is based on that $3.5 million exemption that we have. If it goes back to $1 million and a 55% tax, that number is higher. Plus we would have taxes on our Canadian property, our RSP portfolio, and Canadian controlled private corporation. So what do we do about it? Well, our funding options are really simple. It was mentioned earlier, we could liquidate that property. If we have a tax bill, we have to come up with cash to pay for it. So where do we get cash? Well, we can sell what we have. But if we're building net worth and we enjoy that property, you may want to retain that property. Or you may have situations where some of your family members have grown a real interest in that property, others don't. So how do you then give the property that's worth a lot of money to part of your family and don't deal with the others fairly equally? We can perhaps borrow money to pay the tax liability. That's can be quite common if you want to retain that property, or perhaps for buying out siblings that aren't interested in that real estate. Problem with borrowing is it's costly. The only real good benefit of it is you don't have to deal with it today. So you can let them deal with it. And quite frankly, a lot of people do that. But it's going to be the full value of the tax bill plus the interest costs to fund that. The one that near and dear to my heart and many of our clients is insurance. If the desire is to maintain the net worth in your family and pay the tax with as little dollars as possible, insurance is a solution to consider. And I want to walk through an example of that. So we had a $490,000 tax bill. if you wanted to buy $500,000 of insurance, I just ran some numbers. So assuming we had a couple that were both age 55, they were non-smokers and healthy, they could purchase a joint policy with proceeds payable on the last death. Now we would have a marital tax credit so we can roll property over at first death. So the funding's due when the second person passes away. The premium for that, if you paid it for life, is just about $3,300 a year. So if you live a long time, you're never going to pay what you're getting in terms of tax relief there. And in fact, if we do a present value of that, and assuming that they both live 30 years, your actual cost in today's dollars is just over $65,000. So where can you get $65,000 to pay off a $500,000 tax liability? A lot of clients now want to have these premium obligations funded while they're working so that they don't have to worry about them in retirement. So there has been some creative products that have been around for a long time where you can prepay your insurance policies. And one of the easiest ones to understand in context of what does it cost is guaranteed 10-pay insurance. And there's lots of companies out there that are providing this kind of solution today. And in that case, you would pay a premium of $8,755 a year, 10 years guaranteed, you're done. You never have to pay another premium in this contract. Doesn't matter what it's invested in, doesn't matter dividends or anything like that. This is a guaranteed policy. So you would have paid $87,551 for $500,000 death benefit. If we were to calculate that rate of return, it's remarkable. You know, how can they do that? Well, it's because your kids get it or your charities get it. You don't get to keep it, and that's just how insurance works. Present value cost of that is a little bit more than the pay forever. As you can see, the number crunching there, $74,000 versus the $65,000. But if those clients bought the life pay and still live longer than 30 years, they're still paying their premium. So that's just the difference there. And just to wrap up special considerations with the use of life insurance in these plans, the life insurance does come into that calculation, which is why we used it in the example. If you had that $1 million policy, that would go into your total net worth on the denominator. So your US assets over your global assets. Insurance face amount comes into the calculation. So what you may want to do if you have a very high net worth and you want to use life insurance is the use of an irrevocable life insurance trust in your planning, which will remove it from your denominator to increase your tax credit. And that's all we have for that part of the discussion. We're going to turn it back to Corey, who will MC, ask any questions, and then we'll either send it to one of the panel members.
Thank you, Blair. So we now, as Blair had mentioned, like to open the floor to questions. So if you do have a question, please raise your hand, and I'll repeat it once I hear it. Yes, sir.
It was talked first of all about not allowing the travel.
Thank you. The first fellow had talked about travel to rental property normally not allowed as a deduction. How about when traveling there to purchase the property or to source it out? Would that be allowed?
Excuse me. As far as I'm aware, that wouldn't be allowed either. It's still, that wouldn't be a cost of acquisition, and it wouldn't be a deductible expense either.
Thank you.
No. That'd be analogous to buying a property in Canada and traveling to see the property. It'd be the same situation as far as I know.
Yes, sir.
To make that net election that you were talking about, Christa, do you have to have a taxpayer identification number?
So the question was, to make the net election that I was talking about, do you have to have a taxpayer identification number? And the answer is yes. So
how hard is that to get?
So how hard is that to get?
Yeah.
You know, I have lots of people get frustrated with the process because you have to go to, I believe if you're going to do it on your own, you have to go to a consulate and have them sort of certify your original documentation. MNP is a certified acceptance agent, so we can take your documents and sort of certify them ourselves and submit on your behalf. I think the cost is about $700 for that service. So, you know, people try and do it themselves, and some people are more successful than others. It's just be prepared because it can be frustrating. And you don't want to have to send your original documentation down, so.
Right. And if you own it as joint tenants, do both owners have to get this? They both have to?
Yeah, that's a good question. If you own your property either as joint tenants or tenants in common, the question is, do you both have to get ID numbers? And the answer is yes. So you have to recognize each, like in the U.S., you, as you'd have to each file a tax return to pick up your share of the income, if you're going to make that election.
Yes, sir.
Christa, what's the name of that form that needed to be filed by June 15th?
Okay, so the question is, what is the name of the form that has to be filed by June 15th? So that form number is 8840. It's called the Closer Connection Form. You can get it off the IRS website. So it's pretty straightforward. Again, you don't need a taxpayer ID number, which is nice, but they are asking information about you and your activity in the U.S. So
What was the name of that form again?
it's called, I think it's Closer Connection. The form number is 8840. So if you just go to the IRS website, there's a link that says Forms and Publications, and you click on that link, and then there's a little box where all you need to type in is 8840, and it'll come up as a PDF, and you can download it. You might even be able to fill it in actually right on there. So.
Yes?
I've read something about that there's something called a cross-border revocable living trust that you can hold U.S. property in. Is that an option for rental property, vacation or rental property?
You know, that's an individual. He's an attorney, and that's sort of a product that he's kind of packaged together. Looking at it, I think it's nothing more than a glorified living trust, which is essentially a look-through trust. And at the end of the day, it provides some more protection from a legal aspect rather than an income tax aspect, because I believe you can get the income tax benefits that it provides through tenants in common ownership, to be honest with you. But it does provide, some of the protection for power of attorney, living incapacitation issues and whatnot. So it does have those more the legal aspects, but.
If there are, sorry.
I'm sorry. I think there was some reference made that for properties of less than $60,000, none of the provisions that you enunciated apply. Can you clarify that?
Sure. So say you bought a property that was worth $100,000 and it was validly split between you and another person, so that your share was only $50,000 US when you died. Then the US in their domestic rules, we don't have to go to the treaty, has a provision that non-residents, as long as their US situs property is no more than $60,000 US, you're not subject to US estate tax, and therefore you don't have to file a return. But if you're $60,001, then you have to file a return, and you're into the treaty, and now you're into that we'll call it $3.5 million formula for now.
It's a personal use property, right?
Pardon me?
As long as it's personal use, you don't rent it out.
No, it's indifferent, because when you die from this isn't an income tax concept, this is an estate tax concept. So whether you own your property personally or rent it, it's property that you own at death. So there's no difference from an estate tax standpoint if you own your property personally and are using it personally or are renting it out. So it comes down to ownership when with respect to estate tax, not the use of the property.
So the Income Tax Act, the income tax doesn't apply if you have a trailer in Phoenix for $60,000. You virtually could rent it out, get all the money on it, and you would have to file in the United States?
So the question is, if you had a trailer that's worth $60,000 and you were renting it out and earn money, you wouldn't have to file. And from an income tax standpoint, you're correct. You wouldn't have to file. Hopefully, they're whoever you're renting to is doing the 30% withholding, because you'd be on the hook for that from the IRS if your renter isn't doing that. And then from an estate tax perspective, assuming you have no other U.S. situs assets, so no U.S. stock, no stock in your U.S. stock in your RSP, then you wouldn't have an obligation to file a U.S. estate tax return.
What about on your worldwide income in Canada? Of course, you'd have to file.
Yeah, Canada's totally different. So we really didn't get into too much. I mean, Peter touched on that when, maybe Peter, you want to, like from a Canadian tax standpoint, when you die, you're deemed to dispose of your assets at fair market value, but at least it's taxed on a net basis versus a gross basis perspective. And in Canada, that's on your worldwide assets.
Well, if there's no other questions, we'll conclude this evening. I would like to say a few things. First of all, we've noticed a number of you to use the washroom facilities have been going down to the main level and then down to the basement. Just as a note, there is a washroom facility just across the hall here and down, so there's no need to go all the way down to the basement, and there's much nicer facilities up here, I will say. Also, please stick around. We're going to serve refreshments at the conclusion, so please take your time and feel free to mingle amongst yourselves. And I guess just as a concluding remark, we just wanted to say that what you've heard here this evening is based upon very broad philosophies, theories, and in order to have your own situation looked at, please consult either your own professionals or someone at this table, because each individual and each company's situation is very different, and some of what you've heard tonight may apply to you and some may not. So please consult, like I say, either your own professionals or the people here. So I'd just like to thank all three speakers tonight, and thank you for coming, and I hope you've enjoyed yourselves. And the speakers will be around, so if you do have more questions or would like some clarification, please feel free to approach them later. Thank you.